How's it going, everybody? It's Stas here. Welcome back to another video. So in today's video, we're going to be talking about and breaking down 3 dividend ETFs that I'm buying right now in 2020 and that I've been buying here over the past couple of years in my stock market portfolios. And this kind of piggybacks off of a video that I uploaded a couple days ago about kind of a different topic, but still in the realm of dividend investing, about 3 dividend stocks that I'm buying right now in 2020. And by the way, if you guys want to check that video out after this video, of course, that is linked down below in the description box. So we're going to jump into my computer. I have all 3 of these ETFs pulled up. We're going to jump into some numbers, assets under management, expense ratios, the holdings, the sectors, the industries that the fund is comprised of, everything, guys. We're going to talk about and break down in this video. So sit back, relax, of course, hit that like button and consider subscribing if you want to see further content like this, and drop a comment down below. Let me know your thoughts and let's get right into it. Alrighty, guys, so let's start breaking down these 3 dividend ETFs that I'm buying right now in 2020, starting off here with the Vanguard High Dividend Yield ETF, ticker symbol VYM. And my goal with these guys is not to day trade them, not to swing trade them. It's to dollar cost average into them and eventually live off of the cash flow that's being produced from the investment. And honestly, until I live off of the cash flow, all the dividends that are being produced from the investment in ticker symbol VYM will be reinvested back, maybe into other stocks or maybe back into VYM itself, and this is going to take advantage of compound interest over time, right? So this is a very long-term investment that I don't plan on selling for at least 10, 15 plus years. Maybe I won't ever sell it, guys. I probably won't ever sell it, to be completely honest, or unless I want to invest in real estate, something else, maybe I'd consider selling it, but for the foreseeable future, this will be a cash flow investment, not a day trade, not a swing trade, and that's kind of obvious based off of what the video is titled here. So let's go over what this one in specific does. So VYM seeks to track the performance of the FTSE High Dividend Yield Index, which measures the investment return of common stocks of companies characterized by high dividend yields. It provides a convenient way to track the performance of stocks that are forecasted to have above average dividend yields. And if we take a look here at the ETF facts, the asset class is domestic stock general. So these are companies that are in the United States of America, and the category here is large value, which we'll see in a second here what that means. And the expense ratio is 0.06%, which is pretty much nothing compared to what some of these mutual funds have, which are upwards of 1.52 to 2.5%, which in my opinion, guys, is highway robbery. That is just insane, paying that type of an expense ratio to management just to kind of manage the fund. So going back to what I said about large value, I think it's on this tab. Let me see, portfolio and management here. We can see the stock style and the market capitalization and just the style in general of this fund. It's more large cap and it's more focused on value, right? Some other ones could be medium cap, focused on a blend of value and growth, or medium growth or small growth, which would be very risky. But for me, large value, sure, there's risk in everything, but it's a lot less risky than something that could be more of a growth, right? So for me, that's pretty good for ticker symbol VYM. And looking down here, the number of stocks this thing holds is 400, guys. So you're getting a lot of diversity right off the bat. And the total net assets here are just shy of $40 billion, $39.6 billion to be exact. And scrolling down even further, which is a really important thing here, is the equity sector diversification. Where is your money going in terms of the main sectors of the stock market, the economy? And the way that this fund is split up here, and one thing you'll notice is all three of these funds, they're a bit different, which is why I'm invested in them, to get a bit of diversity, right? But this fund in particular, it's split pretty heavily in financials, consumer goods, healthcare, and technology. Those are the four top ones here, financials being almost 20%. So investing in this one, you're getting a lot of exposure to financials right off the bat, with the smallest one being here, basic materials, at 3.6% of the portfolio. And scrolling down a bit more, we can see the individual holdings of the portfolio, or rather the top 10 individual holdings: JP Morgan, Johnson & Johnson, Procter & Gamble, Exxon, AT&T, Intel, Verizon, Merck, Chevron, and Pfizer. And mind you, these top 10 holdings comprise 26.6% of the total net assets of this ETF, which many people may think that that's a lot just in the top 10. I would agree with you, that is a pretty big chunk, but then again, these are all blue chip companies, and the other 75% is comprised of, 390 other companies, so you're still getting a bunch of diversification, even though it's pretty heavily towards the top 10 here in terms of, these 10 stocks that we just named off. So portfolio and management, that's pretty solid there in my opinion. Some nice diversification, and if we're taking a look at the price and performance here, 1 year is a 14% return, 3 year 9.85%, 5 year is around a 9.88%, 10 year 12.94%. And since the inception in 2006, roughly an 8% return here in ticker symbol VYM. So overall, guys, that's kind of a rundown, and feel free to jump even further into VYM, because you have to. If you're doing your own research and you're looking to invest in something, you have to dive in a lot deeper than just a YouTube video that you're watching and get brief knowledge on the ETF. So let's move on to the second one here, which I think you guys will find pretty interesting as well. And this one, it doesn't have as big of a dividend yield. That's the first thing I want to say. But a lot of people consider this a very quality ETF. Not saying that VYM or the other one that we're going to talk about after this is not quality, because they're quality, but this ticker symbol NOBL in particular focuses on, and it seeks investment results before fees and expenses, of course, that track the performance of the S&P 500 Dividend Aristocrats Index. And this is huge, guys, because if you don't know what a dividend aristocrat is, it's a company that has raised its dividend for 25 plus years. And that's the quality that I'm talking about here. Quality companies with quality management are companies that are increasing their dividends for 25 plus years, and definitely 50 plus years. So this is an ETF that really, investing in it might make you sleep better at night than obviously investing in, let's say, a speculative stock. But that's not the purpose of this video, right? We're focusing on dividend ETFs. So Noble, very, very solid in my opinion. Noble's holdings are the S&P 500 Dividend Aristocrats, like I said, but most of the companies have actually increased their dividends for 40 plus years. So a lot of quality here, guys. I'm loving the way that this thing is ran, but again, it doesn't have as high of a yield as, let's say, VYM or the other one that we're going to be talking about here in a couple of minutes. So let's take a look at the breakdown by sector here. Then we'll take a look at some holdings. Actually, wait, the expense ratio, very important. I believe the expense ratio on this one is around 0.35%. And I just checked, the dividend yield is 1.9% as of right now that I'm recording this video. But mind you, a lot of these ETFs, they're trading near all-time highs. So if we were to see any sort of correction, we'd get a higher starting yield in terms of that dividend if we were to buy into the ETFs. So breakdown by sector. Remember, the previous one was heavy in financials. Well, this one, it has about 11% in financials, but it's heavy in consumer staples, which are staples, right? And these are products that people use no matter what financial condition the economy's in, whether the economy's booming, whether we're seeing a recession. People are still going to need their consumer staples. Their staples, toilet paper, cleaning products, toothpaste, and all this stuff. You guys know the list goes on. So 23% there. Another one that's pretty heavily in this ETF is industrials. And industrials, they, on the flip side, they get crushed a bit more, I'd say a lot more, than consumer staples in a recession. So that's a bit risky, but either way, a lot of these industrials, they offer a nice dividend. I know 3M in particular, you can see it right here, they've been increasing their dividend for 56 plus years. Dover Corp, 56 plus years, Emerson Electric, 56 years. So although their price might get hit in a recession, their dividend, it's still being paid out and it's still increasing, which for the basis of this investment being a dividend investment, that's all I care about, because if the price went down, I'm not freaking out because the cash flow is still there. If anything, I'd be buying more of the ETF at a lower price. So those are the top two sectors. Pretty much 50% of the portfolio, or the ETF rather, is consumer staples, industrials, with financials being third. And you guys can see the rest there if you do want to pause the video. So the top index holdings, actually these aren't the top holdings, these are just the index holdings with the longest records of dividend growth. And we can see here how the dividend aristocrats capture quality. Noble's holdings, the dividend aristocrats, like I've already said 100 times, are often household names. As a group, they have demonstrated hallmarks of quality like stable earnings, solid fundamentals, and often strong histories of profit and growth over multiple market cycles, which I mentioned again a minute ago. And this is massive, guys. Although the yield, again, it's a bit under 2% right now. These are quality companies growing cash flows year over year, and you can even see the higher average return on equity. The S&P 500 Dividend Aristocrats returned 19.1% between 12/31/16 and 6/30/19 around a 3-year period, compared to the S&P 500, which was 15.3%. So the second one here is NOBL. I love this one, and I will buy it whenever it dips, and pretty much every dip that I do see it have. So the third ETF that I want to talk about here is ticker symbol SPHD, and this is the definition of an ETF, in my opinion, that makes you sleep well at night, or that allows you to sleep well at night, because you can see here, keywords, high dividend, low volatility, low volatility. This allows you to sleep well at night because the investments aren't flying up and down, up and down. Now, if you're a person that can handle that, you can sleep well whenever. But if you're a person that strictly wants to invest in ETFs that are stable, low volatility, this would make you very, very comfortable, and I have invested in it, and it's made me comfortable. Not saying that I can't stomach volatility, but for the purpose of the investment, it has been very, very solid. So the overview of this, the Invesco S&P 500 SPHD fund seeks investment results that generally correspond, before fees and expenses, of course, to the price and yield of the S&P 500 low volatility high dividend index. The fund generally will invest at least 90% of its total assets in common stocks that comprise the index. Standard & Poor's compiles maintains and calculates the index, which is composed of 50 securities traded on the S&P 500 that historically have provided high dividend yields and low volatility. The fund and the index are rebalanced and reconstituted semi-annually in January and July. So looking over here on the right, this is the highest dividend ETF that we're talking about in this video. The SEC 30-day yield is 4.39%, and I believe the fee on this one is 0.35%. So right off the bat, you're making your money back just from the dividend yield itself. You're making it back almost tenfold there in terms of what you're paying in expenses, and obviously from what you're receiving in the dividend yield every single year. So let's take a look at the distributions. Actually, no, the portfolios, so we can see what sectors this one's broken into. So remember, VYM was heavy financials. The other one, NOBL, was heavy consumer staples. Well, this one is pretty heavy in real estate, 22.42% in real estate here as of the 7th of January, and financials being 15.25%, with utilities being 14.82%, and you guys can see the list goes on, with information technology being 2.5%, the smallest slice, the smallest sector here in this ETF. So heavy in real estate, and for me, guys, I love investing in real estate, through real estate investment trusts. I have not bought a property quite yet, an investment property that is on the list over the next couple of years. I just want to have exposure to everything, real estate, financials, everything, right, guys? And if we're taking a look at the distributions here, one unique thing about SPHD that I love, it's a dividend monthly ETF. I believe I didn't mention on NOBL, this one's quarterly, but SPHD monthly, guys. Every single end of the month, on the last day of the month, pretty much, it pays you out a dividend, and the dividend over time, of course, is increasing as the stocks in the ETF increase their dividends. So 4.39% dividend yield, expense ratio 0.35%. And taking a look at the performance quarterly compared to the S&P, sure, it's not beating the S&P 500, but remember, the goal of the ETF isn't necessarily to beat the S&P 500. It's to provide a low volatility, high yield, and a pretty consistent return at that, right? So year to date, S&P 500 has returned roughly, 35%. SPHD, on the other hand, has returned, let's take a look here, roughly 20 to around 21%. So pretty solid, right? 20% in a year, that is pretty incredible. 3-year performance, S&P around 15%, SPHD around 8.5%. Not bad. 5-year performance, S&P around 11.7%, SPHD around a 10.6%. And since the inception, guys, the low volatility SPHD ETF, 12.37% return, with the S&P 500 being around a 14% return. So that is pretty solid there, in my opinion, although we're not beating the S&P with SPHD, having a little bit in there, having that low beta, and low beta meaning that this performs, the volatility is less than the market, right? I don't know. Let me see if I can find the beta here. If not, it's okay. But beta in general means that, let's say a company has a 0.7 beta. The market's beta, which is just volatility, guys, that's what that means pretty much, how volatile it is. The stock market is a 1 beta. Anything under 1 would mean that it's less volatile than the market in general. Anything above 1 would mean it's more volatile than the market in general. So that's kind of the premise of SPHD here. And that's pretty much it for the video, guys. I hope you enjoyed it. If you did, feel free to go down below, hit that like button, and consider subscribing to the channel if you want to see further content like this. And let me know, what are your thoughts on these 3 dividend yield ETFs? I'd love to know down below in the comments section. And if you guys want a free stock from Webull, check out my affiliate link down below. Simply deposit $100 and you'll get a free stock, and you can use that free money to invest, do whatever you want with it in the stock market. Thanks again for watching, guys. I'll see you all in the next video. Peace out.